people, welcome back to our sessions. Today we are going to discuss section 5 chapter 1 taxation of partnership. Let's see what is the first question. Regarding partnership, pass through income, which of the following statement is false? A. Partners must report their share of partnership income even if a distribution is not made. B. Neither general partner nor limited partner must pay self employment tax on their net earnings from self employment assigned to them from the partnership. C. Partners are not employees of the partnership. D. Each partner reports his share of the partnership net profit or loss on his personal Form 1040 tax return. Let's see what is the answer. The answer is B. Let's see why the other three answers are wrong. Option A, the statement is true. Partners are required to report their share of partnership income on their individual tax return, whether or not a distribution is made. So, partnerships are passed through entities, which means that profit and loss is passed through to the partners, regardless of whether the partnership distributes cash to the partners. So, option A statement is correct. As we have to find out incorrect statement, A is the incorrect answer, and C, here the statement is also correct. Partners are not considered employees of the partnership. Instead, they are owners of the partnership and are treated as self-employed individuals for tax purposes. So this distinction affect how income is taxed and how employment taxes are applied. And the last one, which is D, this statement is also true. Partnership themselves do not pay income taxes. Instead, the partnership profit and losses are passed through to the partners, and each partner report their share of the partnership's net profit or loss on their personal Form 1040 tax return. So the answer is B. So here the statement is false because partner, both general and limited, generally must pay self-employment tax on the distributive share of partnership income that is considered net earnings from self-employment. Here limited partners won't pay the self-employment taxes, but general partner must pay the employment taxes. So option B is the right answer. Let's go to the next question. Which of the following would not sign Form 1065? A. Fiduciary. B. General partner. C. Unpaid preparer. D. LLC member manager. Let's see the answer. The answer is C. Let's see why the other three options are wrong. Option A, fiduciary is a person or entity that holds a legal or ethical relationship of trust with one or more other parties. In the context of a partnership, a fiduciary could be a trustee or executor of an estate that is a partner in the partnership. So, fiduciaries often have the authority to act on behalf of others. They may need to sign Form 1065 if they are representing a partner that is an estate or trust. And option B, general partner. So general partner are actively involved in the management and operation of the partnership. They have authority to make decisions and manage the partnership's affair. General partner would typically sign Form 1065 as they are responsible for the partnership financial and tax matters. And option D, LLC member manager. So LLC member manager is responsible for the management and operations of LLC. So if the LLC is treated as partnership for tax purposes and files Form 1065, LLC member manager would typically sign the form. So option D is also uh, wrong answer. So the right answer is C, unpaid preparer. So let's see why it is C. So here unpaid preparer who may have assisted in preparing the tax return but does not have a formal role within the partnership would not sign Form 1065. So the unpaid preparer's information and details of their assistance might be included in the relevant section of the form, but they would not be required to sign it. Let's go to the next question. A partnership terminates when a partnership converts into an LLC classified as a partnership. B. At least one third of the total interest in partnership capital and profit is sold or exchanged within a 12-month period, including a sale or exchange to another partner. C. All of its operations are discontinued and no part of any business, financial operations, or venture is continued by any of its partners in a partnership. D. Any of these events takes place. Let's see the answer. The answer is C. Let's see why the other three options are wrong. So, option A, this event does not necessarily indicate the termination of a partnership. So, a partnership converting into LLC classified as partnership is a change in legal structure but might not result in the complete termination of the original partnership. So, option is wrong. Option B, here a significant change in ownership might impact the partnership dynamics. So, this event alone does not necessarily lead to the termination of the partnership. Ownership changes can occur without necessarily terminating the partnership. And D, uh, D is also wrong answer. C is the correct answer because when all operation of the partnership are discontinued and no part of the business or venture is continued by any of the partners, the partnership is considered terminated. Let's go to the next question. A qualified husband wife joint venture may elect not to be treated as partnership for federal tax purposes if all of the following are true except A. The only member of the joint venture are husband and wife. B. Both spouses materially participate in the trade or business. C. Spouses must file a joint return. D. All items of income, gain, loss, deduction, and credit are divided equally between the spouses. Let's see the answer. The answer is D. Let's see why it is D. So here option A, B, C are requirements of a qualified joint venture. D is not a requirement for qualified joint venture because in a qualified husband-wife joint venture, the division of income, gain, loss, deduction, and credit does not necessarily have to be equal between the spouses. So D is the answer. Let's go to the next question. Jeevan sold his daughter 50% of his business partnership. The partnership had a 80,000 profit this year before deducting any compensation to the partner as a guaranteed payment. Material is a capital income producing factor. Jeevan performed services worth 55,000, so which is a reasonable compensation. The daughter performed no services. How much income will Jeevan claim on his individual tax return? A 55,000, B 67,500, C 40,000, D 80,000. Let's see what is the answer. The answer is B. Let's see why it is B. Here, to calculate the income that Jeevan will claim on his individual tax return, we need to consider the partnership profit, the guaranteed payment to Jeevan, and the allocation of income to his daughter. So here, partnership profit before deducting guaranteed payment is 80,000, and reasonable compensation is 55,000. Daughter's ownership is 50%, and here daughter did not perform any services. First, we need to calculate how much income should be distributed to each partner. So 80,000 minus 55,000 is 25,000. This 25,000 is divided between two partners. So here daughter is having 50% ownership. 25,000 into 50% is 12,500 and remaining 12,500 goes to Jeevan. So Jeevan as is having 55,000 reasonable compensation plus 12,500 income. So total is equals to 67,500. Let's go to the next question. The partnership does not choose how to treat A. Depreciation method, B. Accounting method, C. Amortization of certain organization fees, D. Share of foreign taxes. Let's see the answer. The answer is share of foreign taxes. Let's see why it is D. So here partnership do not choose how to treat their share of foreign taxes. Instead, The treatment of foreign taxes paid by the partnership is determined by tax rules and regulations, and the partner must report their share of foreign taxes paid by the partnership on their individual tax return according to these rules. So, option D is the right answer. Let's go to the next question. Which of the following partnership organization expenses cannot be amortized? A. Legal fees for services intended to the organization of the partnership. B. Professional fees connected with the issuing and marketing of interest in the partnership. C. Filing fees associated with the partnership. D. Accounting fees for service incident to the organization of the partnership. Let's see the answer. The answer is B. Let's see why the other three options are wrong. So, option A, legal fees. Legal fees for services related to the organization of the partnership can generally be amortized over a period of time because these fees are considered startup cost and can be deducted over a specific period. And C, here C, filing fees associated with the partnership are considered startup costs and it can also be amortized. And accounting fees is also considered as related to organization of the partnership, so it is also considered as startup cost and it is amortized over such a specific period. So option B is not related to startup cost or organizational cost, so it cannot be amortized. Professional fees connected with the issuing and marketing of interest in the partnership are considered organizational expenses that cannot be amortized. So, these fees are typically treated as capital expenses and added to the basis of the partnership interest. Let's go to the next question. An unincorporated organization, including a limited liability company formed after 1996, is classified as a partnership if it has two or more members and it is not A. Tax exempt organization, B. All of these choices, C. An insurance company, D. An organization formed under a federal or state law that refers to it as a joint stock company. Let's see the answer. The answer is all of these choices. Let's see why it is B. So here, tax exempt organization, insurance company, or organization formed under a federal or state law that refers to it as joint stock company cannot become a partnership because first, tax exempt organization, it is unincorporated organization with two or more partner, that is tax exempt. It is not considered as partnership. Tax exempt organization have their own tax classification, so A is not a partnership. C, insurance company, it is also unincorporated organization with two or more members, that is an insurance company. So insurance company also have their own specialized tax treatments. So C is also wrong. D, so joint stock company, it has a specific legal designation would determine its classification. So D is also wrong. So the answer is B. All of the choices A, C, D cannot become the partnership. Let's go to the next question. A partnership in which James is a 50% owner had a profit of 80,000. The partnership agreement provides for a 50-50 sharing of income. Capital is a material income producing factor. During the year, James performed services worth 20,000. What is the total income James should report from the partnership? A 20,000, B 50,000, C 45,000, D 80,000. Let's see the answer. The answer is 50,000. Let's see why it is 50,000. So here in a partnership, profit are typically shared among the partners according to the terms of the partnership agreement. So in this case, the partnership agreement provides for 50-50 sharing of income. So capital is also considered as capital material income producing factor. So here the distribution of income is based on ownership percentage. So here James is a 50% owner of the partnership and partnership profit is 80% and James performed 20,000 services. Now, here, after deducting guaranteed payment from the profit, remaining compensation is 60,000. So, 60,000 into 50% is 30,000. So 30,000 is related to James' income and is 20,000 is his guaranteed payment. So total is equals to 50,000. 30,000 income and 20,000 guaranteed payment. So total comes to 50,000. Let's go to the next question. Jagan is a partner in the Milan partnership. During the year, Jagan personally assumed 10,000 of the partnership's liability. The assumption of the partnership debt by Jagan is treated as A. Deductible capital expense of the partnership, B. A contribution of money by the partnership, C. A decrease to Jagan's basis in the partnership, D. An increase to Jagan's basis in the partnership. Let's see the answer. The answer is D. An increase to Jagan's basis in the partnership. So here the assumption of partnership debt by Jagan is treated as increase to his basis. So normally partners' basis will increase in three cases. One is when they create or increase the partnership basis in any of its asset, or which give rise to a current deduction to the partnership, or if it is a non-deductible non-capital expense of the partnership. So in these three cases, partnership liability will be increased. Let's go to the next question. Edward and Bobby by form a partnership with contribution of 30,000 each. Bobby By is not a general partner under the partnership agreement. Edward and Bobby By share all partnership profits and losses equally. The partnership borrows 70,000 to purchase depreciable equipment to be used in the partnership business. Edward was required under the partnership agreement to pay the creditor if the partnership defaulted. Based upon these facts, what are the Edwards and Bobby Pye's bases in the partnership? A. Edward 65,000, Bobby 65,000, Edward 100,000, Bobby 100,000, C. Edward 100,000, Bobby 30,000, D. Edward 30,000, Bobby 30,000. Let's see the answer. The answer is C. Edward 100,000, Bobby 30,000. Let's see why it is C. So here in a partnership, a partner's basis is the amount of their economic investment in the partnership. So basis is important for determining the partner's share of partnership income, losses, deduction and credits. So here Edward and Bobby contributed 30,000 each. So here and partnership borrows 70,000 to purchase depreciable equipment. And here the Edward is responsible to pay the creditors. So 70,000, which is required payment to the creditor, plus 30,000 is basis. So Edward's basis is 100,000. And Bobby, as he contributed 30,000 in cash, so his contribution will be 30,000 cash contribution, whereas Edward is cash contribution plus his share of partnership debt. So total comes to 100,000. Edward is 100,000 and Bobby is 30,000. Let's go to the next question. A partner or related person is considered to assume a partnership liability only if certain conditions are true. Related person for this purposes does not include a corporation and a partnership if the same person owns 50% or more in value of the outstanding stock of the corporation and 50% or more of the capital or profit interest in the partnership. Be none of these choices. C. A partnership and a person owning directly or indirectly 80% or more of the capital or profits interest in the partnership. D. An individual and his spouse. Let's see the answer. The answer is B. So here A, C, D are definitions of a related party. So A, the same individual or related entities own significant interest in both a corporation and a partnership. The assumption of liability between them is subject to special rules. So this option describes a related person with who would be considered to assume a partnership liability. So A is a related party and C If a person owns 80% or more of the capital or profit interest in a partnership, that person is considered related, and the assumption of partnership liability would be subject to certain rules. And option D, spouses are considered related parties for the purpose of determining the assumption of partnership liability. So, transfer of liabilities between spouses may be subject to special rules. So, A, C, D are related parties. Let's go to the next question. Regarding a partner's share of recurse liability, which of the following statement is false? A partnership liability is a recurse liability if no partner or related person has an economic risk of loss for that liability. Be absent some other factor. A limited partner generally has no recurse liability. C. Recurse liabilities are allocated in accordance with the partner's risk of loss. D. Partner's share of recurse liability equals his economic risk of loss for that liability. Let's see the answer. The answer is A. Let's see why it is A. So here option statement is false because a partnership liability is not considered as recurse liability if no partner or related person has a economic risk of loss for that liability. So in other words, we could say that if for a liability to be treated as recurse liability, at least one partner or related person must have an economic risk of loss. So option A is the wrong answer. Let's go to the next question. Tanmay and Jagan formed a cash basis general partnership with each contributing 40,000. Under the partnership agreement, they share all partnership profit and losses equally. They borrowed 50,000 and purchased depreciable business equipment. Jagan is required to pay the creditor 100% if the partnership defaults. Jagan basis in the partnership would be A 90,000, B 50,000, C 65,000, D 40,000. Let's see the answer. The answer is A 90,000. Let's see why it is A. So here Jagan initial contribution is 40,000, and share of partnership debt is 50,000 since he is responsible for 100% of the debt if the partnership defaults. So Jagan's total base is 40,000 plus 50,000 equals to 90,000. Let's go to the next question. What is the purpose of Form 1065 Schedule M1? A. To reconcile income loss per accounting books with income losses per the tax return of the partnership. B. To show the partner's share of income and deductions. C. To identify the partners and their share of the partnership. D. To show what caused the changes during the tax year in the partner's capital account as reflected on the partnership's books and records. Let's see the answer. The answer is A. Let's see why it is A. So here to reconcile income losses per accounting books with income losses per the tax return of the partnership, this statement is true. The main purpose of Form 1065 Schedule M1 is to reconcile the income or loss reported on the partnership's accounting books with the income or losses reported on the partnership's tax return. So it helps ensure consistency and accuracy between the financial statement and the tax return. Let's go to the next question. Javed contributes property with FMV of 7,000, adjusted basis of 4,000, and a mortgage of 10,000, which the partnership assumes to a partnership for 40% interest in the partnership. What is Javed basis in his partnership interest? So A 6,000, B 3,400, C 33,000, D 4,000. Let's see the answer. The answer is B. Let's see why it is B. So here FMV, adjusted basis of the contributed property is 4,000, and out of this 1,000, 60% is assumed by partnership. So we need to deduct partnership share. So 1,000 into 60% is 600. So 600 minus 4,000 is 3,400. So Javed's basis is 3,400. Let's go to the next question. Lahari's outside base is in the A to Z partnership at January 1st was 11,000. She is 50% partner and she has profit and losses in the same ratio. For the year, the partnership's ordinary business income was 40,000. Tax exempt income was 200. Lahari received a cash distribution from the partnership of 700 during the year. If the partnership were to liquidate on December 31st, what would be Lahari's basis for determining gain or loss? A. 30,750, B. 30,300, C. 24,900, D. 30,400. Let's see the answer. The answer is D. 30,400. Let's see why it is D. So here Lahari's initial outside base is 11,000 and Lahari's percentage is 50,000. And income, business partnership income is 40,000, tax exempt income is 200, distribution is 700. So here 11,000 plus Lahari is having 50% share in partnership. So income 20,000 into 50% goes to Lahari plus 200. So here it is wrong. Sorry. 40% into 40,000 into 50% is 20,000 and her share is 20,000 and 200 into 50% is 100. So Lahari's share is 100 and 700 she has taken the distribution. So if we deduct that, her basis will be 30,400. Let's go to the next question. Tarun and Varun form a cash basis general partnership with cash contribution of 20,000 each. Under the partnership agreement, they share all partnership profit and losses equally. They borrow 60,000 and purchase depreciable business equipment. Varun is required to pay the creditor if the partnership defaults. Tarun's and Varun's basis in the partnership would be A. Tarun 20,000, Varun 20,000, B. Tarun 50,000, Varun 50,000, C. Tarun 20,000, Varun 50,000, D. Tarun 20,000, Varun 80,000. Let's see the answer. The answer is Tarun 20,000, Varun 80,000. Let's see the answer. So here Tarun and Varun has contributed 20,000 and they all a partnership has borrowed 60,000 and the 60,000 Varun is responsible to pay for the creditors. So Varun's basis will be 60,000 plus 20,000, 80,000, whereas Tarun's contribution will be 20,000. So Tarun is 20,000, Varun is 80,000. Let's go to the next question. Generally, no gain or loss is recognized by the partnership or a partner when the partner contributes property to the partnership unless A. Gain is recognized on the transfer of property to a partnership that would be treated as an investment company if the partnership is incorporated. B. Unencumbered depreciable property is contributed. And C. Partnership is already operating. D. Partnership has been formed. Let's see the answer. The answer is A. Let's see why it is A. So here if a partner contributes property to a partnership and a gain is realized on the transfer, the gain is generally recognized unless the contributed property would be treated as investment company if the partnership were incorporated. So this exception ensures that certain types of gains are recognized. Let's go to the next question. Javed and Tarun formed an equal partnership. Javed contributed 10,000 cash and Tarun contributed depreciable equipment that he has used for 6 months with the FMV of 10,000 and adjusted basis of 2,000. Javed had taken 3,000 in depreciation on the equipment before he transferred it to the partnership. What amount should Tarun report as a gain as a result of this transaction? A. 4,000, B. 0, C. 3,000, D. 8,000. Let's see the answer. The answer is B0. Let's see why it is B. So here in this case, Javed and Tarun has done the contribution. They didn't sell or exchange any property. So this is just a contribution to the partnership. So in case of contribution, no gain or loss is recognized. So the answer is B. So in case of contribution to the partnership, no gain or loss will be recognized. In case of sale or exchange, it will be recognized. Let's go to the next question. If a partner contributes property to a partnership, the partnership basis for determining depreciation, depletion, gain, or loss on the disposition of the property. A is the same as a partner's adjusted basis for the property when contributed increased by any gain recognized by the partner at the time of the contribution. B is the same as a partner's adjusted basis for the property when contributed decreased by any gain recognized by the partner at the time of the contribution. C is the same as a partner's adjusted basis for the property when contributed increased by any gain recognized by the partnership at the time of the contribution. D is same as a partner's adjusted basis for the property when contributed. Let's see the answer. The answer is A. Let's see why it is A. So here when a partner contributes property to a partnership, the partnership basis for determining depreciation, depletion, gain or loss for the property is generally the same as a partner's adjusted basis for the property when contributed. So any gain recognized by the partner at the time of the contribution is added to the partner's adjusted basis to arrive at the partnership basis. So the answer is A. Let's go to the next question. Sagar and Madan formed an equal partnership. Sagar contributed 20,000 in cash to the partnership and Madan contributed depreciable property with the FMV of 20,000 and an adjusted basis of 7,000. Assuming that the depreciation rate is 10% a year under the general depreciation system, how much of the depreciation must be allocated to Sagar? So A is 700, B 1000, C is 350, D 2000. So let's see the answer. The answer is A, 700. Let's see why it is A. So here to calculate the depreciation, we need to take the adjusted basis. Depreciation will be calculated with the adjusted basis. So adjusted basis in this case is 7,000 and depreciation rate is 10%. So 7,000 into 10% is 700. So the answer is 700. Let's go to the next question. Partner A received inventory item with the basis of 20,000 in a complete dissolution of a partnership within 5 years. Partner A sell the entire inventory for 30,000. What amount and type of gain should partner A report? A 10,000 short-term capital gain, B 10,000 long-term capital gain, C 0, D 10,000 ordinary gain. Let's see the answer. The answer is D 10,000 ordinary gain. Let's see why it is 10,000. So the gain or loss on the sale of asset including inventory item is generally classified as either ordinary gain, ordinary or capital gain or loss. In this scenario, partner A received inventory item as a part of complete dissolution of a partnership and then sold the inventory within 5 years. So since the inventory item are considered part of partners A ordinary income generating activity because inventory is held for sale to customer, so any gain from the sale would be classified as ordinary. So here basis of inventory is 20,000. He sold it for 30,000. So the gain will be 10,000 ordinary gain from the sale of the inventory item received in complete dissolution of the partnership. Let's go to the next question. Bharat and Jeevan formed a new partnership. Bharat contributes property that has an adjusted basis of 1400 and FMV of 2000 to the partnership. Jeevan contributes 2000 in cash to the partnership. Each partner's capital account as reflected on the partnership's book is 2000. What is the adjusted basis of each partner's interest? A. Bharat's at 1400, Jeevan's at 2000. B. Bharat's at 1400, Jeevan's at 1400. C. Bharat at 1700, Jeevan at 1700. D. Bharat at 2000, Jeevan at 2000. Let's see the answer. The answer is A. Let's see why it is A. So here Bharat has contributed 1400 property. So we have to take the adjusted basis when calculating the profit. So when calculating the adjusted basis. So here adjusted basis of Bharat is 1400 and Jeevan has contributed 2000. So when they are contributing property, we have to take adjusted basis as basis in the partnership. So over here Bharat property basis is 1400. So his basis will be 1400 and Jeevan as he contributed in cash, his basis will be 2000. So A Bharat 1400 and Jeevan 2000 is the answer. Let's go to the next question. Mohini acquired 30% interest in a partnership by contributing property that has an adjusted basis to her of 25,000, FMB of 50,000 and 40,000 mortgage. The partnership assumed the liability. What is Mohini's gain or loss on the contribution of her property to the partnership? A 12,000 gain, B 10,000 loss, C 3,000 gain and D 0. Let's see the answer. The answer is 3,000 gain. Let's see why it is 3,000 gain. So here, since partnership assumed the mortgage, so 70% is 70% is assumed by the partnership and 30% is related to Mohini. So 70% into 40,000 will be 28,000 and his adjusted basis related to property is 25,000. So 25,000 minus 28,000 will be his 3,000 gain. So Mohini gain will be 3,000. So let's discuss the remaining questions in the next session.